Hey, welcome everybody. Thanks for those who are jumping on and our attendees. We're really glad to have this session. This is session number 4 of SolarConnect. And let's get started. My name is Brent Thurgood. I'm the head of operations at Enerflo. And we are featuring today our head of business development, which is Phil Kaiser. He's also going to be the moderator today. And he's joined by Sean Hayes of Palmetto Lightreach. Welcome, Sean. And Eric White from Dividend will be joining right behind us. And then Michael Picata from Thrive Power are all on the panel. So thanks everybody for jumping on. And that's it. I'll hand it over to Phil. Thanks, Phil.
Awesome.
Thanks, everybody. Good luck.
Thanks, Brent. Appreciate it. Super pumped to spend some time with all of you guys today on the call. Michael and Sean, you guys weren't on the last time that we had this session. It was February this year. We spent a lot of time talking about sales and install compliance, items around recheck, and digital welcome calls, and warranties, strengths and weaknesses. Those items are definitely still relevant and important to today, but I think we're at an inflection point as far as the industry goes today, right? So over the next hour, we're going to be talking more about what those items look like from your perspective as 25D, FIAC, compliance, capital requirements, constraints, and ultimately the rise of storage. It's definitely going to be a great conversation. I'm excited about it. I think you guys are industry leaders and you have a lot of expertise and knowledge to bring to the table. I believe we're going to have Eric White join us from Dividend once he fixes his computer. But in the meantime, we can, oh, here he is right now, just as I said that. Perfect. But before we kick things off, I'd love to help give our audience just a little bit of a perspective and knowledge of who you guys are, the companies that you're with, and what you guys are about. I'd love to just take a minute. It doesn't have to be super lengthy or anything like that, but take a minute and let everybody know who you are, your company, the company you're with. And if you could finish it off with what's the most surprising thing that you've learned in solar this year? Because there's been a lot of stuff that has happened throughout this year. I think in the beginning of the year, nobody saw what was going to happen and where we're at now. Michael, if you want to kick us off and let us know who you are and what
Sure.
Thrive is all about.
Yeah, sure thing. I'm one of the co-founders of Thrive. My responsibilities span investor relations and strategy, although I find myself doing pretty much everything in the company, as I'm sure Sean and Eric may be able to relate to. Something that's surprising that happened this year. I was surprised to see that residential projects under 48E, so small resi projects qualifying under 48E, maintained ITC eligibility, and we pretty much came out of that unscathed. I thought we were going to be affected more than we were. Sad to see 25D go, but that would be how the BBB ultimately landed. It surprised me.
Yeah, absolutely. I don't think a lot of people saw that one coming. I thought it was definitely heavily weighted to one way towards 25D initially, and then it was everything shifted the other way. So, Sean, how about you?
Yeah, well, first and foremost, thanks for having us, Phil. Sean Hayes, GM of Palmetto Lightreach, so oversee day-to-day business. If you haven't heard of Palmetto Lightreach, we are a PPA and lease provider across about 35 states and 175 utilities. Biggest surprise, probably the executive order in FIAC. I think we'll touch on that here on this panel, but did not expect to potentially lose about 40% of the resi solar panel market to the nuances associated with FIAC.
Yeah. It's never a dull moment in solar. There's always something that's going on. So Eric, and I think no stranger to the panel here. You've is it the third one that you've been on? But if you wouldn't mind just sharing a little insights about. Yeah, every time. If you wouldn't mind just share a little insights on you and Dividend and what's something that surprised you this year.
Eric White, founder and CEO of Dividend, a business of Fifth Third Bank. I should mention, as a publicly traded bank, I'll speak more to the industry more broadly, and anything I'm discussing as it relates to Dividend will be things that are already out in the public domain. So I just want to throw out that quick disclosure. But to be honest, nothing really surprised me that much this year. Honestly, going into the year, kind of my base case and our base case was 25D goes away, and then 48E probably survives in some capacity. No, I agree with Sean and some of the others around some of the fiat stuff. I mean, that concept didn't really exist last year, so obviously it's a surprise. But at least as far as it relates to our business, it's kind of a moot point, given we don't really play in the TPO space.
Love it. Love the insights, guys. Really appreciate it. Yeah, so let's dive into the fun stuff and the reason why we're all here, right? I know our audience they're gonna want to know a lot of key insights from you guys. And Eric, don't worry, I'm not going to ask you some insider information relevant to dividends. So feel free to share very high level information, but really ultimately our audience is more looking for just guidance from what you guys are seeing in your space and how they can be better supported from you, right? So just keep that stuff in mind as you're answering today. So we'll start with the first elephant in the room, right? There's a couple throughout this year. There's 25D and then there's FIAC, right? So we'll start with 25D first. What are we, like 6 weeks away from the end of the year? So as we were closing in the end of the year, and starting to cause some concern within the market, right? Installers are racing to get projects permitted and PTO'd before the deadline. And so dealing with those concerns and there's also concerns around just general ITC demand or post ITC demand. So with all that in mind, how do you see this reshaping demand and the overall product mix, and what adjustments are you making to help dealers stay competitive as incentives evolve and deadlines approach? I'll kick it to whoever wants to jump first, or I'll pick one. Eric, there you go.
Yeah,
Sean,
sure.
you
I mean,
look like you're excited.
Sure,
Go ahead, Eric.
I'll take it. Yeah, I mean, look, I think obviously the elimination of 25D has had pretty significant implications with respect to product diversification, with a market shift to TPO and just kind of a softening of demand overall. As far as kind of what, as I said before, this was kind of our base case heading into the year. And maybe that's just kind of a function of my mentality of plan for the worst and hope for the best. But we kind of were already making plans for this type of scenario as early as like last November, around the time of the election. So in terms of what we've been doing, we've really focused on being kind of the steady hand in the space. Obviously, we're part of a bank and have kind of the staying power and balance sheet to be more patient and be kind of more reliable and kind of look past a lot of the volatility. And from a product standpoint, some of the things we've been working on are integrating home equity products into solar and home improvement more broadly. And you'll hear more about that next year, which we think will be a significant portion of the solar finance story going forward.
Love it. Sean?
Yeah, happy to jump in. I think always kind of glass half full approach. Taking a step back, I think the broader industry has a really interesting opportunity in that, you know, the amount of power demand that is coming online or that will need to come online in the next, 3 years is insane, right? I think the quotes I've heard is it's like the equivalent of 8 or 9 New York Cities worth of power required. That is a huge opportunity for residential solar as a whole, as far as solving the problem. So irrespective of 25D going away, I think there's a ton of tailwinds for residential solar and a lot of problems that can be solved. And so I think one, that's an exciting piece. Obviously, we found ourselves on the sort of the receiving end of better news than expected with 48E remaining. And allowing us to sort of have a extended runway, unlike 25D. So for us, we sort of believe there's a big opportunity to support installers in making a transition over to third-party ownership if they haven't done so already, or if they historically haven't sold the product. So I think we generally see a really big opportunity to potentially work with partners that may not have otherwise jumped into the third-party ownership space. So I think we're generally, excited about that opportunity, and I think fairly bullish on the opportunity as we step into 2026 and beyond.
Great. And Michael, you're kind of a mix and Threat Power. Threat Power is more focused on like prepaid leases and stuff, right?
Yeah, we have two different products. We have just a standard monthly PPA. We're on the right side, I guess, of how 25D fell there. But our prepaid PPA is an interesting product where we rely in most cases on lenders to still support the homeowners in lending for prepayment in our prepaid PPA. So we are very excited at the prospect of a stronger incentive to work with lenders and bringing the prepaid PPA to new markets.
It's exciting. So, do you guys, view 25D as with the sunset? It sounds like you guys are very bullish. Doesn't matter what the outcome is, right? Going into next year, is there one area where installers should be focusing more of their time on from a diversification standpoint?
Yeah, I mean, I think
Like loans,
I'm happy to
CPO,
take that.
cash.
I think,
Yep. Mhm.
yeah, I mean, I think the key word is diversification. I mean, we're in turbulent, volatile times. Even though we do have clarity on at least kind of what tax credits exist and what ones don't going forward, how you actually qualify for those credits, I think there's still a lot of open questions, whether it relates to safe harboring, whether it relates to the kind of FIAC rules, some of the DOMCOM requirements. So just a lot of things are in flux. There's going to be innovation, new products entering the market. Obviously, the prepaid has gotten a lot of attention, and I think the key is really just being diversified. There'll be things that don't work, especially when you're talking about new innovative products. And maybe they'll never work. Maybe they won't work the first time around, and need to work out the bugs. So I think the key is really being patient, really keeping a close eye on your bottom line versus prioritizing growth, and make sure you have kind of that diverse suite of products and not getting overextended in one particular direction, and ultimately delivering value to your customer at the end of the day. That's the most important thing.
Yeah, I agree with Eric there. I think the most important thing is focusing on delivering value to the homeowner. It's going to be a wild ride in the first quarter of 2026. There's FIAC, there's DOMCOM, there's 25D going away. All of those are converging to create a very turbulent period. So I would encourage, just advice to an EPC, I would encourage them to take a look at their commissions, at their pricing structure to homeowners, and maybe think about compressing that, finding ways to kind of batten down the hatches, do cash projects with homeowners, so that's not reliant on loans or on TPOs, just as a way to diversify the products that they're offering. I think that's a smart move. And yeah, what Eric said, I'd say focus on, if you're an EPC, focus on your cash flow, make sure that you can batten down the hatches and get through Q1, so that everyone in the industry is kind of getting their sea legs and figuring things out and charting a path forward after that.
Only thing I'd add there, agree, big +1 to Michael and Eric's commentary, is diversity in equipment providers and distribution partners. I think the equipment point, I think this is the tightest I've ever seen supply chains get in the 14 years I've been in the space. 12 of which was overseeing a resi solar installer. So I think diversity in equipment is going to be really helpful. Just being nimble and willing to have that especially on panels. And I think that a lot of folks are used to sort of always having the product that they need when they need it, and I don't think that's going to be the case. So I think forecasting is going to be really, really critical. And I think cost stacks are going up, right? I think that's the other big thing that folks just really need to prepare for. I think batten down the hatches, to Michael's point, is it's going to be more expensive to install the same exact project in 26 that you had installed in 25. So be very cognizant of your cost stack and your margin.
Yeah, definitely. And I think that's a good segue into the second elephant in the room, which is FIAC. And I think it's kind of giving everyone a headache right now. As far as just general guidance, right? From compliance and domestic content rules, and you just mentioned too, where it's tightening sourcing, across the industry as far as equipment goes. Um, you know, a lot of manufacturers, I think, aren't prepared to handle the demand, are ready to support the demand. And a lot of installers are trying to, scramble right now, and, get their hands on, what is deemed compliant, equipment, right? I was just talking to an installer the other day, and, he's got, $1 million worth of solar panels sitting in his parking lot right now. And he's just trying to, get whatever he can. So how are you guys seeing these shifts impact equipment availability, general pricing and installer agility across different markets? And, how are your financing programs responding to those supply chain constraints specifically, right? What guidance or recommendation do you have for your installers? I know, Sean, you just kind of touched on it a little bit, but if you can kind of go a little bit deeper as far as, just on the equipment realm, what guidance do you guys have for your installers out there on, what they should be looking for as far as what could be, potential issue for, what would qualify for, a compliant module, right? Where do you see shortages coming for specific mods, or, should they be partnering up with certain distributors or whomever, right? What does that all look like, for the installer going into next year?
Yeah, yeah. Well, one, I'd say this is the most time I have spent thinking and talking about solar modules, in 14 years. I joke I talk to our supply chain team more than I talk to my wife at this point. And so he's a great guy, so that's not a bad thing, I guess. But yeah, I think the thing I would say is that you just need to be very, very cognizant of what folks believe will be fiat compliant modules, and what will not. And again, like, taking a step back, I've probably given 10 webinars on fiat at this point, but like, fiat, just at its core, it doesn't matter where it's manufactured. It matters who manufactured it. And it's not just the top line, like Q cells, it's all of the subcomponents and subcontractors, right? Because there's not a vertically integrated stack. Everybody's using different third parties for different parts. So there's just a lot of things to parse through. And candidly, we're all reliant on the information that the module manufacturers are able to provide. And so it's been a slog, but I think our general guidance has been, there's a handful of module manufacturers, based on the diligence we've done alongside Deloitte, that are seemingly going to be FIAC compliant, right? Q cells, top of the list, of course. Sirius is a new one that's sort of come online, has a Houston manufacturing plant, Turkish-based company. There's Hyundai, of course, which is sort of, I think, making a new entrance in a bigger opportunity for them in the market. And so there's a handful of that are sort of clear and will be in the kind of green zone. And there's a lot of folks that are not. And I think that the challenge is the supply of the folks that are fiat compliant is very, very restricted. So we've been working closely with our distribution partners and signing supply agreements with them, which allows us to sort of guarantee that, based on our current forecast, we will have panel availability. But it's not, it's not like, oh, we know it's going to be Q cells and Hyundai or Sirius. It's like, it's going to be a hodgepodge of all of those different, REC. It's going to be a hodgepodge of those. And everyone just needs to batten down the hatches and be prepared to change, from REC to Q cell to Sirius, to Hyundai in a given month, because it's whatever you can get, and that's going to be, I think, the mentality is flexibility. Be prepared to be flexible.
Yeah, I would agree with that. I think if I had advice to any PC, it would be to focus on being asset light. I would stray from trying to predict which panels, which modules are going to be FIAC compliant and stocking up on those. They're not the right party to do that anyway. So that would be my advice in the next couple quarters, where things are fairly uncertain on how they'll shake out. I think the best advice would be to stay asset light and be able to be nimble and flexible. And I would encourage them to develop stronger relationships with their suppliers, in whatever form they can. I'm seeing a strong push for EPC and supplier and financier to be more highly aligned and much more coordination between those parties. I foresee that only getting stronger into 2026.
Yeah, absolutely. So on the topic of flexibility, right? The installers, I mean, a lot of installers I know can be pretty nimble and flexible. But a lot of the challenges can arise when they get access to a panel, from their distributor, that's readily available, meets the requirements. However, it's not really readily available on your AVL yet. Like, how flexible are you guys going into next year with your AVLs?
I would say that AVLs are becoming a lot less flexible, right? I think they've historically been more flexible, and there is a lot less leniency that you can have, because if you are installing a panel that is not fiat compliant, you lose the ITC, which is a huge impact. So I think for us, we are restricting the amount of module manufacturers that we have on our AVL probably in half. And the intent there is not to be punitive, but it's just that's kind of the reality where we face, and we're trying to do our best to be proactive in giving signals early on as far as what those OEMs are. But I think, it's unfortunate. There's just going to be a lot less leniency that folks have with AVLs given the FIAC restrictions.
Yeah, there's never been more riding on the right selection of panels. So I agree with Sean 100%.
Yeah, and what I would say, just from kind of the lending perspective, in general, given we don't have there isn't a tax credit. I think the AVLs are more focused on, is the equipment of kind of a certain degree of quality or high quality. So I think some of the supply constraints that you're seeing on the module side that are going to directly impact kind of the TPO market may not be as relevant for the let loan or ownership market. So you may actually see some cost advantages and kind of capacity advantages as it relates to procuring modules for ownership.
Yeah, I think that all makes perfect sense too, especially your perspective, Eric and Sean and Michael, on just the diversification between all of your different products and how you guys treat the AVL, products that are going, like, for your AVL for next year, right? So not from the TPO perspective and the loan perspective, knowing what we know now as far as industry goes and FIAC requirements and everything. What type of guidance are you providing your current partners to help them better prepare, or what type of support are you providing your partners today to help them, be better prepared for next year?
I'm happy to jump in. I would just say we have been, I think, as proactive as we possibly can with providing the list of manufacturers that we believe will be FIAC compliant, and guidelines to allow them to start to make purchasing decisions now. And then I think the other piece is, again, we've signed supply agreements with a couple key distribution partners to secure FIAC compliant material on their behalf. So I think those are the two things we've worked hard to, as best we can, provide some advance notice and support.
Awesome.
Yeah, I think those are really the only two things you could do. We're safe harboring material this year as well, and then trying to give as clear guidance as possible on what the AVL will look like in 2026.
Awesome. Yeah. In times of uncertainty, support, is definitely going to matter as far as, who you're partnered with and everything. So I'd love to hear that stuff. So let's shift gears a little bit and kind of go into the tax equity capital flow constraints that we've been seeing throughout this year. Eric, I'll tee this one up for you to kick it off, and then Sean and Mike, if you want to jump in after. So we've seen interest rate swings, tightening tax equity markets, that are making financing conditions, tougher across the industry. And even with some general hope of some future rate cuts and access, from what we're hearing, access to capital is still kind of relatively uneven. So how are those pressures affecting your programs? How are you adopting, new plans, new strategies, to maintain rate stability with shifting rates while supporting installer growth?
Yeah, and the tax equity question isn't really as relevant on my side, although I can kind of speak to kind of a few takeaways there. But at least as it kind of goes from our perspective as a ownership lender, I mentioned the HELOC or home equity type financing product that will roll out to the market next year, which may also provide tax deductibility on the interest portion, I should mention. And is just generally a lower cost product than kind of a traditional installment loan, given that it is secured by equity in the home. So I think that's kind of one big point. As it relates to tax equity, I think there's still quite a bit of capacity, but it's side a little bit of hesitation around how to kind of look at FIOC. Which I think introduces some additional compliance as far as kind of the prepaid goes. We'll see how institutional equity embraces that or not. I think to date it's been more kind of doctor and dentist type tax equity that has really supported that product. And institutions in general are just always going to be more conservative. So I suspect you'll see more of a wait and see approach there. And it may take some time until tax equity markets at the institutional level really embrace that product or not. And then really the last point I would make is I think just kind of more generally at a macro level, this overall shift in the dynamics in play definitely favor kind of larger, very well capitalized players. Think like Sunrun that have balance sheets and can get kind of a sizable safe harboring facilities in order to purchase a bunch of capacity that they can safe harbor. And unfortunately, it really will hurt smaller, less capitalized players, which is 99% of the space.
Sean, Mike, any perspective on your end?
I would say, like, coming off of Trump's election, there was a lot of uncertainty in the space just around future policy. And so I think that we collectively saw less excitement and a lot more investors sort of standing on the sidelines awaiting guidance. Although, OBBBA wasn't great for the industry as a whole, it did provide certainty, right? And I think what investors hate, uncertainty. So we got the uncertainty off the table. We sort of had the playing field that was outlined, and I think that for us, that we saw more folks that were kind of sitting on the sidelines jump in, and so I think from a capital standpoint, although there are complexities with FIOC and safe harbor, I think that we have sort of seen a much larger spike in interest to get into the space. I think the asset class as a whole is one that's performed quite well, even with bankruptcies. I think the silver lining of bankruptcies is it's allowed asset owners, ABS holders, to observe transitions and see how the asset performs. And I think the assets generally have performed pretty well, specifically on the TPO side. So I think as a collective, I think we are seeing a good bit of renewed interest in the space as a whole, and generally pretty optimistic about the go forward.
Yeah, I agree with that. We're optimistic about the go forward. We're continuing to see stable demand since we've gotten certainty from the BBB on what the outlook will be for the next few years. The constraint, FIOC and domestic content, those are restrictions that we're dealing with that will impact stability of tax equity going forward. There's solutions to that. I think everyone will get comfortable with that. So, the focus on supply is going to be an important piece today and moving forward. That I think is the largest bottleneck.
Yeah, I think it's that like supply in general. It's just going to be interesting to see how that all plays out into next year. Um, so we already touched on product diversification a little bit earlier, but I want to dive a little bit deeper into it because um, what we've seen, on our platform from the beginning of the year, we had it was roughly about, it was like 50 40 10 split, right? So between TPO, loan, and cash. As of last month, it's around 66 23 12, right? So there's definitely a bigger shift going into the TPO market, which kind of tracks with what was being portrayed with on Metal Lakes earlier. Um, and also on Mental Lakes reported that, prepaids are going to have, an expected stake in the general TPO market as well, or taking some share from the traditional TPO. But we've seen this story before, right? With when we talk about diversification, like we've seen this story before where installers will put all their eggs in one basket. And that can have, potentially, very harmful impacts to their business, in the future by doing that. So, diversification is key, right? But would you say that, diversification is more important today than ever now that we are starting to see a heavy weight with TPO and, kind of limitations on, TPO providers, and there's only so many people that people could choose. Or how should dealers really be balancing their product mix to stay resilient, and profitable across every market? Because there are markets where it's like, TPO doesn't necessarily make sense in those markets, right? So how are you working with your partners that, may be working in a wide range of different markets where it may make better sense for them to do another product?
I mean, I think it kind of is consistent with what I was saying before. Like you need to meet your customer where they are. They're the most important thing, delivering them value. And then secondly, ensuring, and I guess it really goes with one, ensuring that, you have a business that can continue to operate and you remain solvent. So it's important that you have access to multiple products, both to meet customer need and also to, reduce concentration and exposure to either one particular finance partner or one particular product, just given the volatility in the market. I mean, God forbid there's a scenario where fiat guidance comes out and kind of undercuts and kneecaps, a whole host of safe harbor strategies. You would want to make sure you're not overexposed to that, and then as kind of encouraging and high potential as kind of the prepaid product looks like, it's going to take time for that product to really be embraced by the market, both from a consumer perspective, how it's actually sold, and then from a capital markets perspective. So, not getting kind of too kind of overexcited and overcommitted to that until the market's actually had a chance to react to it. So I think it's important to really have lots of different offerings with multiple providers.
I think if there's anything we've learned in the last 2 or 3 years, diversity of capital providers is really important. If you're single threaded and you rely on one specific finance provider and they fall down, it just puts an immense amount of pressure on your business. So I think the advice, and we tell everyone, you should always have multiple providers in the space. And I think that there's always, it's good to have as many tools in the tool belt for your sales base to offer, to Eric's point, the customer and what's best for them. If you're a customer in Massachusetts or Illinois and you've got lucrative incentives, maybe it doesn't make sense to go TPO if you've got the ability to, get a HELOC, a dividend, right? So I think there's always going to be, customer situations that require you to have multiple tools in the tool belt. And I think, again, financier diversification is super critical in case something goes awry.
Yeah. Doing a TPO is more simple. So I would encourage installers to have a two-pronged approach. One would be have their suite of TPOs that they like and they have good relationships with, and diversify on the TPO front. And then also have a separate product, which would be a loan where they're striving to compress their soft costs as much as possible, and where FIOC is not a concern. I think if you diversify your offering as an EPC into those, broadly those two buckets, I think you're going to be in the best position to weather any storm.
Yeah, I love that. I really think, I mean, diversification it truly is key, in today's day and age. You have to be able to have, a lot of flexibility between, the people that you're working with from a TPO provider, your loan providers, and you all had excellent points on that, especially, when you consider, when potential risks of FIOC, guidance issues that could potentially come up, next year, that, those are still some uncertain things that I think we're all a little unsure about. So, yeah. So, aside from the product mix, we can, talk about storage a little bit too, because, storage is definitely, starting to become larger and larger. Attachment rates continue to climb. It's starting to become a hotter topic, especially in markets in, like, California, Arizona, Texas, Florida. Do you guys think it's just kind of a general pulse? Like, are we moving closer to, storage as a must-have on every deal, or is it rather still kind of like a nice to have, right? And as battery adoption grows and time of use rates, structures expand, how are financing products evolving to support storage as a natural add-on?
I can just speak to attachment rates. Oh, sorry, Eric.
No, I was going to say, I think clearly, if you look at the numbers, there's definitely, growth in attachment rates, and Michael can probably cite the actual figures. And, especially in time of use markets, it's becoming an increasingly important part of the value proposition. I mean, just in California alone, kind of the NEM 3 world, it took about 18 months, following NEM 3 going into effect for kind of the market to really understand how to sell or purchase storage. But now it's kind of the default in California, and I think you'll see that trend in other markets. I mean, my biggest concern on the storage side is I think we're still quite early from a hardware standpoint in terms of kind of what are the best options out there. And are there going to be kind of major leaps and jumps in kind of the quality, reliability, and capabilities of batteries? And it's both the battery hardware and probably equally as much the interoperability of battery hardware, solar hardware, and kind of the software that kind of acts as the energy management system for that particular property, and eventually, allows it to interact with wholesale markets via kind of virtual power plant type programs, which I think, it is probably inevitably the future. It's just a question of how long it takes to be embraced at scale. And, from a financing standpoint, I mean, at least on our side, we're certainly working on some things just to make it easier and more flexible to finance storage, including storage only loans. But the hardware and kind of interoperability question are kind of the biggest areas of concern / opportunity from my perspective.
Yeah, sorry, I was just gonna jump in and say that. Sorry, Sean. Jump in and say that on we're seeing near 100% attachment of storage onto PV projects in California. Texas, the percentage is above 50% and growing. Apart from savings and arbitrage that a homeowner could play to save money, there's just a matter of resiliency, and we're seeing homeowners really value resiliency, and so that's also leading to higher attachment rates. I think the end game for all of these batteries is to have established pathways to take advantage of demand side grid services, virtual power plant programs, other ancillary services. But that is an evolving problem that that is different from jurisdiction to jurisdiction. So I don't see clear solutions to that yet. I'm sure those will make themselves known over the coming years, but that's it's not clear exactly what that solution looks like, at least from my seat.
Sean?
Yeah, a few quick thoughts. I think one, macro perspective, the biggest challenge that is always levied against resi solar is that it's not dispatchable, right? It's can't store it, and therefore it's not great for the grid. And so I think as a collective, it's great to see battery attach rates nationwide rise, because I think that helps defend sort of the resi solar value prop. So good to see the progress. I think there's a handful of buckets that are driving it, right? You have TOU markets like California, Arizona, and then you have resiliency markets, Puerto Rico, Florida, Texas, and then you've got incentive driven markets like Illinois. So I think there's different drivers depending on where you are. But I think as a collective, we're seeing more and more folks raise the hand for resiliency. I think the challenge is storage is an expensive add, and so I think that solar has historically been a savings proposition, and when you add storage, it if you're not in a TOU market like Arizona, California, it's kind of an anchor to the deal, unless there's a true driver on resiliency. But even then, it's like, well, go get a Generac generator that's cheaper, right? So I think the big crux for us is how do we solve the cost, and that's a combination of OEMs, but it's also utility policies, and or just installation labor. So I think there's still a little ways to go before we see adoption rise in markets that don't have those key drivers. But I do think that there are as Eric mentioned, storage only leases or loans were coming out with a storage only lease. So I think that there's more sort of opportunity to support existing customers that an installer may have sold a couple of years ago. Go back and get the opportunity for a cross sell or an upsell with a battery. So I think that we'll see more of those products emerge in the coming years, which I think again is a net positive for us.
Love that. So adding more storage to the product portfolio, which is awesome. I think the going into next year from a storage perspective, I think the challenge I have with storage is that it's just like it doesn't necessarily make sense in every single market. To your points there, and so do you think that we will eventually get to that point, or is it just still we have to solve the cost problem and everything first? Like, is this a few years, 2030, 2035, you think we'll actually get to a point where storage will be pretty much the norm on every single deal, or is this still going to be a nice to have for the foreseeable future?
Outside of unless there are market forces driving it, I think that it's going to be 6 to 10 years before you're seeing attach rates of 80% plus nationwide. I think there's still a lot of things to do on the cost front before storage is going to be compelling across a wide footprint.
Yeah.
That's my take.
Yeah, I think the cost problem is linked to the availability of local VPP programs, DSGS programs. So that leads me to believe that the solution in 6 or 10 years is going to be highly dependent on the state in which you are operating.
Awesome, guys. Well, appreciate it. Brent's going to give me the warning that we're running out of time, right?
I mean, we're sort of at time, but if there's anything else anyone wants to wrap up or add before we close out, go ahead.
Well, let me throw this one at you guys, and we can wrap it up with your final takes on this. I'd love to hear from your crystal ball, looking at the next 6 to 12 months. It could be transformative next year, or turbulent. So what are you guys seeing as potentially the biggest disruptor or opportunity in the next 6 to 12 months, and what's one strategic move you would advise your dealers to prepare for that future?
Yeah, I mean, we hit on this in a few ways over the course of this session, but you know, focus on cost management, cash flow, profitability. You know, I think as many, if not majority of installers have learned over the last 2 years or so, it's never too early to cut costs. Now is the time to really ensure that you have staying power. Don't let your ego kind of get ahead of yourself, and make sure that you're alive, because I think, you know, coming out of 2027, and then, you know, for the foreseeable future thereafter, once things have kind of the markets reset, you know, the macro tailwinds behind the sector are incredibly strong. I think Sean kind of mentioned the growth in demand from just kind of the overall kind of grid capacity standpoint, you know, from data centers, AI, and whatever else. So if you can kind of make it through, you know, this next, call it 12 to 24 month period, and come out on the other end, you're in a great position. So it's really about staying power for that kind of short-term interim period.
Yeah, I think all of that is correct. Underneath what Eric said, I would focus on, if you're an EPC, just noticing the trend every time there's a major change in the solar industry. The EPCs that are asset heavy are the first ones to go. So focus on being asset light, try to work very closely with suppliers and be nimble, take a look at all of your costs and cut where you can, and enjoy the storm, I suppose. Turbulence and transformative, I think those aren't mutually exclusive. I think both of those things will happen in the first part of next year.
I would just say residential solar installers are the most resilient businesses I have ever met. Plain and simple. Like it takes a lot to take down a residential solar installer. But I think I'd echo all the comments from Eric and Michael, and I would say that my view is now's a great time to also figure out how to diversify outside of solar. You know, is it HVAC? Is it roofing? Is it generators? I think there are more programs that are far more approachable for folks to allow a diversity in revenue stream, so you're not single threaded on PV. And I think 2026 is a great opportunity for folks to start to wade into those waters if they haven't already.
Love it. Love those insights, guys. Yeah, so I mean, it's a couple of things, right? It's staying flexible, diversify, understand your markets, partner wisely. So love all your insights, guys. Really appreciate it. Super valuable. And Brent, I'll let you take it from here.
Yeah, we did have two quick questions, I think. One says the FIOC rules aren't finalized, are they? Is one of the questions.
No,
Okay.
they're not. Using domestic content tables is the guidance that's been given by the IRS. Yeah.
Thank you, Sean. And then finally, which proposal tools do we turn to for selling prepaid PPAs and leases? I'm staying out of this one.
Yeah, that's right. The major design tools are acceptable. So whatever you're using, Solar, Aurora, those will all be acceptable.
Yeah. Okay. Well, big thank you to Michael and Sean and Eric and of course Phil from Enerflo. We appreciate your time. We appreciate great discussion. I took a bunch of notes behind the scenes here, so we appreciate that. And thank you to our attendees. You'll find the recordings available on the page that you joined us on. And you can also find more information after the event is completed at enerflo.com/SolarConnect. Thanks everybody and have a great day. Appreciate it.
Thanks.